Good day, everyone, and welcome to another segment for our Financials Financial Forum. We are here today, Marcus Fryer, here with Jeffrey Campbell, and this is February 18th. Here to kind of catch up on last week's news, give you guys some insight on what's going on this week. And then in our Wealth Wisdom Corner this week, we will be talking about taxable accounts in our tax-free series here. So without further ado, we will get started with our markets in motion section. Let me get it up here on my screen.
Mhm.
All right, Jeff, markets in motion. What we got going on? Give us our market recap from last week.
Yeah, so just to get it started, stocks did pull back. It's kind of the AI disruption fear spread. So we got some U.S. equities that declined last week as mixed economic data and rising concerns about AI-driven business model disruption kind of weighed on consumer sentiment. So that kind of gave us a little negative hit. So the S&P 500 is down 1.39% from last week. Nasdaq is down 2.1%, and Dow is down 1.23%. Not too much, but yeah, a little bit of a decline. Then we kind of, as I touched on, kind of the AI disruption fears. It did hit multiple sectors. So, big tech initially led markets higher earlier in the week, but optimism faded as the AI concerns broadened beyond financials. Traders were worried that rapid AI adoption could pressure traditional business models and potentially accelerate job displacement. So kind of affecting multiple different sectors, not just the tech sector, but multiple different sectors. And then the data swings, the economic data throughout the week. So retail sales were flat in December, missing expectations and raising questions about consumer momentum. The jobs report, strong headline numbers sparked a brief rally, but deeper revisions revealed weak job creation in late 2025. Then inflation, January CPI cooled to 2.4% year over year, kind of easing from the December's 2.7% pace and helping markets rebound Friday. So good news there. And then that kind of leads us down into our financing focus.
All right, cool. Let's kind of touch back on that the AI piece,
Mm,
and we'll get into it a little bit further too when we get into the financing focus and the job market. The AI is a kind of a big concern in terms of taking over jobs. And gosh, you know, in speaking with recent
hmm
graduates and their difficulty in finding employment is pretty tough.
hmm That's hard. And it's almost like a catch-22 in some ways, because in some ways it does help a ton as far as procedural things, and kind of keeping up with the day-to-day tasks, but it cuts out a lot of jobs for a lot of different people.
Yeah, and like I said, that's a good point, Jeff, because if you think about it, if it's going to intercept many of your repetitive tasks, I should say,
hmm
or administrative,
hmm
and those administrative tasks have been, I guess, for your lower educated people,
hmm
then gosh, that pushes those people from out of a professional workforce environment into kind of a, just to the fast food and service
hmm
sector, um, which is, not kind of what we want to see, I wouldn't think.
Exactly. It makes those entry level jobs hard to come across now.
Absolutely. 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 So then that propels into you don't get the exposure in that industry or sector. So how do you gain experience and learn about a particular business if the entry
hmm
level positions are gone? So that's
Exactly.
yeah, gonna have a huge impact.
On the employees and the employers, because now you
Mhm.
don't have anybody, like you said, that came up in that industry doing the entry level stuff, and you're looking for already experienced people, which we have a lack of because nobody has the experience, has been able to build up the experience through the entry level and can grow and through a company. So it's a weird place.
Yeah, it really is. It really is. And then it's impacting, like I said, a lot of people. Then your middle management is going away.
hmm
So, you know, where's your leadership gonna come from?
Exactly.
Interesting. All right, so let's get on to section two, our finance in focus. We're gonna drill down a little bit further on some of these concepts we're discussing now. So let's
hmm
what we got going on finance in focus this week.
So we got a little bit of good news, a little bit of bad news, and kind of three key reports that we saw. So retail sales, the bad news in there is that the December spending stalled after November's 0.6% gain. But on the good side of things, softer demand may encourage the Fed to rethink its cautious stance on future rate hikes, which we kind of touched on the last couple episodes. So that's the good news there. Employment, bad news is job gains were heavily concentrated in one sector. So 2025 job growth was revised sharply lower. And then on the good side of things, January hiring more than doubled expectations and employment edged down, which is always a positive thing to see, especially to start off the year. So, and then kind of as we go into inflation, bad news is inflation remains above the Fed's long-term target. So we're still growing at a pace higher than expected. And then good news is the CPI cooled more than expected, offering another sign that price pressures continue to ease. So hopefully we get some more of that good news on that side, especially. So,
Yep, absolutely, absolutely.
hmm
Yeah, CPI cooling down was good. Went
Yeah.
down to 2.4, still above the long-term rate of 2 that we hoped
hmm
for, but coming down. And I think in your hiring section, I think it was healthcare where most of those jobs were.
hmm
I think that's the sector that saw the greatest gain was healthcare. Let's see. This week, our economic calendar. Of course, the markets were closed yesterday for President's Day. I mean, I should say Monday for President's Day. Wednesday, we'll get housing starts and building permits from the end of the year. We'll get the Fed meeting notes on Wednesday. Thursday, we'll get jobless claims and pending home sales. And Friday, we'll get the Q4 GDP and new home sales and consumer sentiment. So we've got some good indicators to kind of help people see where the market is and some more things on the economy. How about the earnings reports this week? What companies are reporting this week?
Yes. To start the week, Tuesday, the big one is Medtronic. And then we're going into Wednesday and we got Carvana and DoorDash reporting on Wednesday. And then Thursday, a couple more big dollars. We got Walmart and Deere.
Okay.
A couple big
Okay.
dollars reporting earnings.
Yeah, and I think we had touched on that last week. A good chunk of people had already reported, so we had a
hmm
good bit of data already. But
hmm
more heavy hitters, as you're saying, coming in this week, especially Walmart, one of our
Yep.
bellwethers, of course, will give us some insight on how the consumer is holding up, of course.
hmm
Awesome, awesome. All right, so this week, our Wealth Wisdom Corner, we're talking taxable accounts in our strategy, four-part strategy. We've already addressed the Roth accounts. Last week was traditional IRAs, and today we're talking about your basic taxable brokerage account. So, Jeff, what's the do a little quick compare contrast your Roth versus your traditional. Now we've got this taxable brokerage account. So, what's the features of a taxable brokerage account as they differ from the Roth and traditional IRA?
Yeah, so I think the biggest difference is flexibility as far as choosing what you want to invest in and then managing those investments as well. You kind of have full freedom to invest in what you choose to, and then you can contribute as much as you want to and access those funds without restrictions and penalties outside of taxes. And that's unlike retirement accounts, because as we kind of touched on the last couple of segments, there's restrictions on accessing those funds, of course. And then, unlike retirement accounts too, on that taxable side, taxable accounts do not provide those immediate tax benefits that a retirement account would. So I think those are the biggest things. I don't know if I missed on anything on that, Marcus.
Yeah, no, I think you hit on the two things, which leads to it's a taxable account. Tax efficiency
hmm
has to be managed in that account
Exactly.
because you could have different things that are either kicking off dividends or capital gains,
hmm
and a lot of times those things get reinvested. But most people I know don't like paying taxes on money they didn't touch. So
Exactly.
our big thing is to kind of manage the tax efficiency of those accounts because they, you know, contribute a lot to the performance. Now, as it relates to the strategy, that is going to be the account we're going to draw from up to a certain point because there it does exist what's called a 0% capital gains tax bracket. So if we can
hmm
fill up that bucket, that's going to contribute to this the third leg of our tax-free retirement strategy. So that's why that
hmm
taxable account becomes important as well. The Roth, the traditional, and now the taxable brokerage account. And then next week we will touch on the health savings account. which is the big
Hmm.
winner, the triple tax efficiency. Wonderful. So, hey, y'all stay tuned. We're almost to the end of that tax free strategy. Then we'll wrap it all together with a concrete example. You guys can see exactly how it works. So, until next week, we will see you guys. Everyone, have a great week, fantastic week. Be sure to tune in, share with your friends. Again, we're pushing out content, pushing out information, and we just want to make sure the community is well aware. Jeff, any parting words for the week?
Not at all. Everybody have a good week. If you're in North Carolina, enjoy some of this nice weather we're getting after all the bad weather. So that's about it. See y'all next week.
Absolutely. All right. See everyone next week. Thank you. Goodbye.